Everybody's dream is to live off dividends forever, and the fastest way to do this is not through broad market ETFs or even growth ETFs, but through a 2 ETF portfolio that involves a traditional dividend ETF that pays dividends every single quarter and a covered call dividend ETF that pays its dividend every single month. Now, before we get into the nitty-gritty of this investing portfolio strategy, if you truly want to retire early and live off your dividend income as soon as possible, then you need to build a portfolio that does these 5 things. Number 1, beats inflation either through dividend payments or capital appreciation. Number 2, contains high quality and well-established stocks or businesses. Number 3, contains diversification. Number 4, does not cut or decrease its dividends. And number 5, has dividend growth. Because ideally you want your dividend income to continue to grow every single year to not only beat inflation but also have enough money to pay for any expenses that might come up, such as a mortgage, car payment, or other basic necessities. Because in this video, I'm going to be showing you the best 2 ETF portfolio that contains the fastest way to live off of dividends forever. I'll even walk you through some of the pros and cons of investing in this 2 ETF portfolio, as well as showcasing a dividend calculator at the end of this video for the results of our 2 ETF portfolio that I'm going to be creating for you guys. So without further ado, let's get started. Kicking us off with the traditional dividend ETF slot of our portfolio, the best ETF is going to be SCHD, or Charles Schwab's US Dividend Equity ETF. However, some other great funds that can even replace SCHD in this slot are going to be many other great funds like the ones that you see on your screen, because these ETFs will have higher dividend yields than the S&P 500 and even have great dividend growth, so our dividend income never runs out. Why I even chose SCHD is because it has a super solid dividend yield of over 3.5%, and its dividend yield is so high that it even crushes all other ETFs on average in its category. SCHD also has an insane dividend growth rate of over double digits over the last 5 and 10 years, and SCHD has been able to grow this dividend every single year over the last 12 years. Now, this is important because if you choose to stop investing completely in SCHD or not sell out of this fund when you retire, you actually will be able to make more money through dividends every single quarter. This is why Seeking Alpha gives SCHD an A+ rating for its dividend scorecard. In addition to the dividends from SCHD, the returns are wonderful, posting over 10% average annual returns. So you will not only receive high dividend payments to live off of dividend income in retirement, but you will also have your money grow fast as well through capital appreciation, thanks to some of the best and largest high quality, well-established companies that pay a dividend, which is a great problem and combo to have. Moving on to our covered call dividend ETF slot in our 2 ETF portfolio, the best ETF is going to be JEPQ or JEPI, the JP Morgan Dream Duo, but for this video, I'm going to only be choosing JEPQ. For some background knowledge, some of you guys might be wondering, well, what the heck is a covered call ETF? Well, these funds generally buy stocks that track an underlying index and then sell call options on them to generate their income. So for JEPQ, it buys and owns stocks from the NASDAQ 100 index and then will sell call options on these stocks to generate those monthly high-yielding dividend payments, where its current dividend yield is just under 10%, which is insane for a dividend fund, and which is why I'm including it in our 2 ETF portfolio to live off of dividends as fast as humanly possible. And JEPQ is not going to be as risky as those new YieldMax ETFs, which I personally don't recommend at all if you truly want to live off of dividends as fast as possible and reliably as possible, because they are basically a return back of your capital. On JP Morgan's website, it says that JEPQ seeks to deliver monthly distributable income and NASDAQ 100 exposure with less volatility. Now, the key word here is less volatility, because if the NASDAQ 100 were to see a huge pullback, the dividends of JEPQ should act as a cushion in a bear market, which is great for our goal of living off of dividends in retirement. all because we really don't want huge volatility in our portfolio in retirement, and those high monthly income payments are going to be great to pay off of some expenses that we might incur in retirement. Both SCHD and JEPQ individually offer some great benefits to a dividend investor, but combined in a portfolio, their individual strengths combine perfectly to have that dividend dream team. So when you combine both of these ETFs, you get the benefit from JEPQ's super high dividend payment that pays its dividend every single month, as well as SCHD's super aggressive growth rate in their dividends, so we never run out of our dividend income even in retirement. And both of these funds have super solid and high starting dividend yields, and they will both offer good capital appreciation. Moving on to the cons or downsides of this 2 ETF portfolio, if I'm really keeping it real with you guys, this portfolio will not, I repeat, will not outperform the S&P 500, VU, or other great broad market ETFs in the long run. One reason why is because these funds' goal is not to provide capital appreciation as their main strategy, but rather to provide high and sustainable dividend payments. With covered call ETFs like JEPI and JEPQ, you basically forego the highest upside potential in your portfolio because you sell call options on the stocks that you own in these funds, and basically in dummy terms, JEPQ will always trail whatever index it mimics, so JEPQ will always underperform a like-minded ETF like QQQM, since these both are NASDAQ 100 type ETFs. And with dividend-focused ETFs, they mainly don't have the highest exposure to tech stocks, which have been providing the best returns in the market over the past couple of decades. And even if tech stocks don't perform well in the future, those broad market ETFs have much more diversification in its sector holdings and in general to eventually carry its long-term performance better than dividend funds primarily will. Another con is this portfolio is only meant if you want dividend income as soon as possible and not if you want the highest returns possible. So if you are, say, really young or have a significantly longer time horizon than the average person, then this portfolio might not be for you, and you should actually research some broad market or even growth ETFs to have a better chance of outperforming or at least keeping up with the market. Con number 3 is, I would say, the risk of this portfolio is going to be just as high as broad market ETFs. And the last con is you are going to have to pay taxes in this portfolio if you have these ETFs in a taxable brokerage account and not a Roth IRA. I'm going to have the help of a dividend calculator, and I'm going to be using a 50-50 split into SCHD and JEPQ with an initial $10,000 investment in both of these funds separately with an annual contribution of $200 per month in each of them, or $2,400 per year, which I believe is going to be very doable for the average dividend investor that wants to live off dividends as fast as possible. And then lastly, I'm going to be comparing the results of only buying the famous S&P 500 ETF VU. One quick note is if you want dividend income now as fast as possible and you have a shorter investing time frame, then you could increase your allocation to JEPQ more than SCHD. On the other hand, if you have a longer time horizon and dividends aren't a priority right now, but you still want to live off dividends as fast as humanly possible, then you could allocate more of your money to SCHD than JEPQ and increase that holding. Always turn on DRIP and reinvest your dividends, and please note that I'm going to be using data in our dividend calculator that's going to be very conservative. So with $10,000 invested in SCHD and contributing $200 per month in this fund in year 1, we would have $373 in annual dividends. By year 10, we would have over $2,500 in annual dividend payments. By year 20, we would accumulate almost $11,000 per year in annual dividend income. And then by year 30, we would be receiving over $44,000 per year in dividends, all while accumulating over $322,000 in dividends over the course of 30 years in SCHD. With JEPQ, in year 1, we would have over $916 in annual dividends due to its high yield. By year 10, we would have over $4,700 in annual dividend income. By year 20, we would be receiving over $12,400 in dividends, and then by year 30, we would be receiving over $25,000 per year in dividends, all while accumulating just shy of $300,000 in dividends over the course of 30 years in JEPQ. I don't know if you noticed, but JEPQ actually provided higher starting annual dividend income compared to SCHD, and then over time SCHD actually provided more dividend income than JEPQ because that's the power of a high dividend growth rate, or a CAGR, of SCHD compared to JEPQ. Hence why I said if you want dividend income right now, to have a higher allocation to JEPQ than SCHD, and if you want to have higher dividend payments hopefully in the future, and dividends aren't a priority right now, to have that allocation more towards SCHD. If we add up both investments in SCHD and JEPQ, our annual dividend payments by year 30 would be over $69,987 in annual dividend payments, which is going to be way more than enough to live off of dividends in retirement, and this is not including the amount of money our money actually grew in capital appreciation. Versus if we only invested in S&P 500 ETF VU for dividends by year 30, we would have only $2,527 in annual dividend payments. Overall, I would say to take these numbers with a grain of salt, because you really can't predict the future of share price returns, annual dividend growth rates, or even the predictability of dividends, as well as dividend calculators don't take into account for all the data, I believe, to accurately predict your dividend income in the future. All in all, it's still going to take you a number of years to get to a point where you can comfortably and reliably live off of dividends, with the best of both worlds of combining both JEPQ and SCHD, because investing is a game of patience, being invested in the long run, and just investing is not there to make you get rich quick, and it's not a scam or scheme. If you guys like this video, please give it a like, because this Q Puppy did, and right here is going to be a video about JEPQ and how much JEPQ you should have invested by every single age for the best returns possible, and right here is going to be another great video on how you can retire off of SCHD. I hope you guys have a great rest of your day, continue to crush in the stock market, and take it easy. Peace.